My name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants and LightPoint Portfolios. This is your December 2021 market update. Well, 2021 was a solid year for financial markets as the economy's ability to adapt to the pandemic, the passing of additional fiscal stimulus, and low interest rates all supported strong developed market equity and commodity performance. The strong 28% plus performance in large cap U.S. equities was primarily driven by unprecedented gains among the S&P 500's largest tech stocks. In contrast to 2020, small cap U.S. equities trailed their large cap peers with a 14.82% return, although this was still above the 20-year average of 11%. Outside the U.S., international stocks had another strong year with an 11.26% return. Emerging market equities, on the other hand, contracted 2.54% following a correction in the Chinese stock market in the second half of the year and continued lockdown measures throughout the region. Turning to commodities, severe supply chain bottlenecks and a surge in energy prices were strongly supportive of performance. And finally, for investors in gold, 2021 was a disappointing year with prices down 4.14% on a strong US dollar. And it was the biggest yearly decline for gold since 2015. Unfortunately, the strong economic backdrop and higher inflationary readings led to rising interest rates in 2021, creating a very different performance result than equities for most fixed income asset classes. For example, the Bloomberg U.S. Aggregate Bond Index, which is a proxy for U.S. investment grade bonds, lost 1.54%, while global bonds fared even worse, contracting 4.71%. Emerging market bonds were down 1.8%, and two of the few relative bright spots in fixed income markets were inflation-protected bonds and high-yield bonds, both up over 5% on the year. On a quarterly basis, and especially at the end of the year, I'd like to share some market insights and our outlook with you. We believe that any investment strategy should start with a broad assessment of the economy and the markets. But as you can imagine, these can be complex topics. So I'd like to simplify our insights by answering three key questions for you. One, does the economy look healthy going forward? Two, are stocks cheap or expensive? And three, is the current market trend weak or strong? Meaning, is the market likely to change direction soon? Let's start with the economy. Following a weak third quarter, economic growth is accelerating over the winter, prompting a sharp fall in the unemployment rate and contributing to strong growth in corporate profits. One of the ways we can assess the economy on a forward-looking basis is by looking at a chart of the leading economic index, or LEI, which is shown here. The LEI is comprised of 10 different economic variables that indicate the short-term future course of various sectors of the economy, such as manufacturing orders. And as you can see here, historically, the LEI, which is indicated by the blue line there, has turned down before a recession, the gray shaded areas, and upward before an expansion. The exception to this was 2020 because you can't forecast a pandemic-induced recession. But the latest reading released on December 20th of the LEI rose sharply higher, which suggests that despite a resurgence in COVID-19, ongoing supply chain disruptions, and inflationary concerns, the current economic expansion is likely to continue in the first half of 2022. So overall, we say that this indicator is positive. Next, we'll look at asset prices, also known as valuations. This helps answer the question, are stocks cheap or expensive? If stocks are cheap, we may want to overweight stocks versus bonds, but if they're expensive, we may want to take some of our profits. This chart shows the valuation on the S&P 500. On a forward-looking basis, stocks are currently selling at about 21 times forward earnings. To interpret this, this means that investors are willing to pay $21 for each dollar of future earnings. And relative to history, this is expensive. However, it's important to note that the top 10 stocks in the index, those are stocks like Google, Microsoft, Amazon, shown by the green line, are significantly more elevated than the rest of the stocks in the index. Currently, there is a very wide dispersion in valuations, meaning that active managers like ourselves can still pick up holdings that are cheap relative to our forecast of value. Additionally, it's important to note that we still have very low interest rates, and that in and of itself is supportive of stocks. Now, in 2022, interest rates are likely to rise due to inflationary pressures, and we also expect economic growth to slow in the latter half of 2022. And there's likely going to be higher corporate taxes. And combined, these things can impede earnings growth. So as such, investors like yourselves may want to recognize the limited potential for gains in broad U.S. equity indices in the year ahead, given where valuations are right now. But this is one of the reasons why we have a significant portion of our portfolios allocated to international stocks. Relative to domestic stocks, international stocks are trading at significant discounts, and we are positioning the portfolios where we see value. Now let's answer our third question, which is the market trend strong or weak? We like to answer this question by looking at what is known as market breadth, with this simply a measure of how many stocks in an index are participating in the uptrend. If the number of stocks in a strong uptrend starts to fall, that means that fewer and fewer stocks are holding up the index. The top of the chart, the dark blue line, shows the S&P 500 index in a strong trend for many months. And the red line, which is a measure of market breadth, has been somewhat volatile over the last few months with the news of the no COVID variant and the stalling of the Build Back Better Act in Congress. However, it appears to have bottomed, and currently it stands at about 80%, which indicates strong market participation. So this is also positive for the market. Looking ahead, above trend growth for the U.S. economy remains our base case scenario, given the continued backdrop of low interest rates by historical standards and significant fiscal policy accommodation focused on ensuring that the recovery continues. We do expect interest rates to rise gradually in 2022 as the Federal Reserve moves to rein in inflation. However, even with increases in interest rates, savings accounts are likely to continue earning negative rates of return after accounting for inflation. So keep that in mind as an investor. Bonds continue to serve as both a store of value and as a potent hedge for risk assets. However, returns are likely to be very muted given current interest rates. In aggregate, we are underweight bonds and prefer to invest in alternatives, as well as parts of the bond market that offer relative value in order to hedge some of the risk we see right now in the bond market. Turning to the equity side, domestic stocks appear expensive relative to history, but cheap relative to bonds, which is supportive of the backdrop. And international stocks remain attractive relative to domestic stocks. As always, we thank you for your continued confidence, and please reach out to us with any questions you may have.